Hello everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of chapters 1 and 2 from the book How to Make Money in Stocks by William O'Neill. It has been created with the help of AI. The theme is reading stock charts. You can read the original post at samfury.com.
Hey everyone, and welcome to this deep dive, where we're going to kind of go behind the scenes of the stock market. Today we're learning how to read those mysterious stock charts. Our guide for this whole journey is going to be William O'Neill's book, How to Make Money in Stocks.
Yeah.
And we'll be focusing on recognizing the signals and patterns that can point to a stock that's ready to kind of take off.
Yeah, it's almost like being a detective, right? Looking for those clues.
Yeah.
But before we grab our magnifying glass or whatever, we need to really understand that charts, they're just one tool
Right.
in our toolkit, right? They tell a story, but we need more information to fully understand it.
That makes a lot of sense. Yeah, it's like seeing footprints in the sand.
Yeah,
Someone was there, but not the whole story.
right.
O'Neill really emphasizes that point in the book, right?
Absolutely. He's all about combining those charts with solid company fundamentals.
Right.
Earnings, sales, return on equity.
Yeah.
Those are the building blocks. Charts can reveal some exciting patterns, but those patterns are far more reliable when the company itself
Right.
is on solid footing.
Okay, so let's talk about those charts then.
Right.
What story are they telling us,
Mm-hmm.
and how can we start deciphering the language?
Yeah, so every stock chart is really a visual record of that stock's history.
Oh,
It's
yeah.
price movements, how many shares are being traded, and that's volume, all laid out over time.
Right.
And just like you might notice patterns in your own daily routine,
Right.
there are patterns in these charts that repeat over and over again.
So it's history repeating itself,
Yes,
but in the stock market.
precisely.
That's fascinating.
See, human behavior, the dynamics of supply and demand,
Yeah.
these things drive the market, and they're fairly consistent over time. The patterns that played out with winning stocks decades ago can still give us valuable clues today.
Wow, I'm starting to see how this all fits together.
Good.
Now, O'Neill talks a lot about these things called bases. What are they, and why are they so important for us chart detectives?
Yeah, so think of a base like a pit stop during a race car's run around the track.
Right.
After a stock has had a strong price increase, that's the first part of the race,
Right.
it often needs to pause and consolidate. That pause, that period of correction or sideways movement, that's the base.
Okay.
It's where the stock catches its breath before the next potential surge.
Okay, so it's not just about lines going up all the time.
No.
We need those pauses, those bases,
Correct.
to set the stage for the next big move.
Exactly. And within these bases, we start to see those patterns emerge, giving us clues about what might come next.
Okay.
One of the most well-known and reliable patterns is called the cup with handle.
Now that sounds intriguing. Is it as elegant as the name suggests?
It really is. Picture a teacup, nicely rounded at the bottom,
Okay.
and then on the right side, a slight dip forms like a little handle.
Okay.
That visual is what we look for on the chart.
So we're searching for a rounded dip followed by a smaller dip.
Yes.
Got it. How long does it usually take for this pattern to form?
Typically, a cup with handle pattern takes several months to develop.
Okay.
Somewhere between 3 and 6 months is the sweet spot.
So this isn't about quick trades. It's about patience and observing how the pattern unfolds.
You got it.
Hmm.
Now, before a stock even starts forming that cup, it needs to have shown some strength.
Right.
We want to see a prior uptrend, ideally at least a 30% increase in price
Wow.
and strong trading volume to confirm that buyers are genuinely interested.
Okay.
We're not just looking for any cup. We're looking for a cup that has already proven its ability to climb.
That makes a lot of sense.
Yes.
So not all cups are created equal.
Right.
We want to see a history of upward movement before we get too excited.
Yes.
But what about those times when the overall market takes a dip?
Mm-hmm.
Do those downturns mess up these patterns?
That's a great question. Market downturns or corrections can definitely shake things up. One of the things O'Neill cautions us about is watching how a stock performs relative to the overall market.
During those dips, if the stock plunges significantly more than the market average, that's a red flag. It suggests there might be something fundamentally wrong with that company.
Yeah,
And we need to be extra careful.
that's a really helpful tip. Thanks. Now back to the cup with handle pattern. We talked about the cup part, but what makes the handle so important?
You know how in a good mystery novel, there's that moment of final suspense right before the climax? The handle is kind of like that. It's the final shakeout before the potential breakout.
Okay.
It's usually a smaller dip in price, lasting a week or two where trading volume dries up.
Right.
And O'Neill found that cups without handles are far riskier.
Oh.
They tend to fizzle out more often.
So the handle is like a confirmation, a signal that the stock has shaken off the last of the hesitant sellers
Yes.
and is ready for a potential surge upward. It's making more and more sense now.
You're getting it.
Yeah.
And there are a few things that make a handle particularly strong.
Ideally, it forms and the upper half of the cup stays above a technical indicator called the 10-week moving average,
Okay.
and the price doesn't drop more than 8% from its peak during the handle formation.
Wow. There are a lot of details to watch for.
Yeah.
It's really like learning a whole new language.
Right.
What's a 10-week moving average?
Yeah.
And how can someone who's not a professional chart guru understand that part?
You're right. Some of these terms can sound intimidating at first,
Yeah.
but they're actually pretty simple once you break them down.
Oh,
The 10-week moving average is like a smoothing tool
okay.
for the chart. It helps us see the overall trend of the stock's price
Mm-hmm.
by averaging out the price fluctuations over the past 10 weeks. Imagine you're trying to draw a smooth line through a bunch of scattered dots.
Okay, yeah.
The moving average is like that smooth line giving us a clearer picture of the trend.
That's a great analogy.
Yeah.
So a strong handle stays above that smooth trend line, showing us that the stock is still holding its upward momentum. Okay, it's all starting to click.
Good.
I like it.
Right.
I'm getting it now.
Awesome, exactly. It's all about confirming that underlying strength. Now, have you ever noticed those periods where a stock's price hardly moves for several weeks?
Yeah.
It just seems to bounce around within a narrow range.
Mm-hmm.
O'Neill calls these tight areas,
Okay.
and they can be really interesting.
I think I've seen that before, but I wasn't sure what it meant.
Right.
What's happening behind the scenes during those tight areas?
Well, it's like a coiled spring gathering energy.
Okay.
Those tight areas can signal accumulation,
Mm-hmm.
which means that large investors, sometimes called institutional investors because they manage big institutions' money,
Right.
are quietly buying up shares. They're not making a big splash. They're accumulating a position patiently,
Yeah.
and then boom, you get a breakout.
So that's what he calls the pivot point.
Yes.
The moment when the stock bursts out of that tight range.
Precisely. And when that breakout happens, we look for a surge in trading volume, at least 40% above normal. That surge in volume confirms that there's real buying pressure propelling the move.
So volume is a critical piece of the puzzle.
Yes.
It's not just about the price, it's about the conviction behind that price move.
Exactly. Volume tells us a lot about the story behind the price action.
Yep.
For example, low volume at the bottom of the cup, and the handle is usually a positive sign.
Mm-hmm.
It suggests that there aren't a lot of people rushing to sell their shares, even during the dip. It indicates a healthy accumulation phase.
That makes sense.
Right? On the other hand, if we see big volume spikes at key points,
Yeah.
that's often a sign of those large institutional investors making their moves. They have the buying power to really move the price.
Okay.
And one more thing to keep an eye on is the relationship between closing prices and volume.
Mm.
If we see more weeks where the stock price closes up on high volume compared to weeks where it closes down on high volume,
Okay.
that tells us there's more buying pressure than selling pressure overall. It's like the bulls are winning the tug of war.
So we're watching for low volume during those dips, high volume on breakouts, and more up days on high volume.
You got it.
But what about when the market as a whole is in a downturn,
Right.
one of those dreaded bear markets?
Mm-hmm.
Do these patterns still apply?
That's where things get a little trickier. O'Neill points out that most chart patterns actually form during bear markets,
Really?
but he strongly cautions against buying breakouts during those times.
Why is that? Wouldn't a breakout in a bear market be even more impressive,
Right.
showing real strength?
It might seem that way, but remember, in a bear market, fear is running high.
Right.
Many of those breakouts turn out to be false starts. It's like trying to sail a boat in a hurricane.
Yeah.
The conditions are just too volatile, and you're more likely to get swept off course.
Okay, I see your point. So what's the best strategy during those turbulent bear markets?
Patience is key. O'Neill recommends using those times to build up your cash reserves, analyze your past decisions, and learn from both your wins and losses. Think of it as a time for reflection and refinement so that when the market turns bullish again,
Right.
you're ready to make informed decisions.
That's great advice. So we've spent quite a bit of time on the cup with handle,
Mhm.
and it's clearly an important one.
Yeah.
But are there other patterns we should be on the lookout for?
Absolutely.
What other formations can give us those valuable clues?
There are several other patterns that O'Neill identifies as reliable indicators. There's the saucer with handle, which is basically a shallower and wider version of the cup.
Okay.
Takes a bit longer to form, but the principles are similar. Then you have the double bottom, which looks like a W on the chart.
Okay.
It signifies a potential reversal after a downtrend, kind of like the stock is bouncing off a support level twice before heading back up.
A W for winner.
I like it.
There you go. Are there any patterns that are particularly well suited for those times when you've maybe missed the initial big price run up and are looking for a second chance to get on board?
You're reading my mind. That's where the flat base pattern comes in.
Hmm.
It's when a stock takes a pause after a strong move, moving sideways in a tight range for a few weeks.
Mm-hmm.
It's like the stock is catching its breath before resuming its climb.
Mm-hmm.
And similar to the flat base is the square box. This consolidation pattern usually forms after a stock has already moved up from a previous pattern,
Right.
indicating another potential leg up.
These all sound like really valuable patterns to learn.
Yes.
It seems like there are a lot of possibilities once you know what to look for.
Right.
What about those high tide flags you mentioned earlier? Those sounded intriguing.
High tight flags are one of the strongest patterns, but they're also quite rare.
Okay.
They involve a rapid, almost vertical price rise, followed by a brief tight consolidation period before another potential surge upward.
Hmm.
Think of it like a rocket launching into space.
Okay.
It has a powerful initial thrust,
Mhm.
then a brief pause to adjust its trajectory before blasting off again.
So it's like a supercharged version of the other patterns,
Exactly.
signifying really strong momentum.
And sometimes these patterns can appear in combination. O'Neill also talks about multi-stage patterns like the base-on base and the ascending base. These often form when the overall market is in a downtrend.
Oh.
So they require extra caution, but they can signal a stock that's showing resilience even in a challenging environment.
Wow. It's amazing how much information is packed into these seemingly simple charts. It's clear that learning to read these patterns can be incredibly valuable.
Yes.
But are there any patterns that we should avoid altogether? Are there any that tend to be unreliable or misleading?
There are definitely some patterns that O'Neill advises steering clear of triangles, coils, and those wide and loose charts where the price swings are erratic and unpredictable.
Okay.
Those tend to be unreliable. They don't give us a clear signal of accumulation and organized buying pressure.
So tight and well-defined is what we're looking for.
Yeah.
Patterns where we can see a clear structure and a story unfolding.
Precisely. And one of O'Neill's key principles is that for a pattern to be truly reliable, it needs to have at least 7 weeks of price consolidation.
Oh.
This allows enough time for the stock to shake out the weak holders and attract strong committed buyers. The only exceptions to the 7-week rule are those high tight flags, short-term flat bases, and square boxes, which tend to develop more quickly.
That makes a lot of sense.
Yeah.
Those shorter term patterns are like quick bursts of energy while the others need more time to build up that base of support.
Right.
Now, earlier you mentioned that the inverse head and shoulders pattern isn't as reliable as some others. What about the regular head and shoulders pattern? Is that one we should be watching for?
The head and shoulders pattern, that one's definitely worth paying attention to.
That's
It's
true.
actually a pretty strong indicator.
Mm.
But unlike the other patterns we've talked about, it's not a buy signal, it's a warning sign.
This is like a get out while you can?
Exactly.
Right.
When you see that head and shoulders pattern forming with 3 peaks resembling, well, a head and 2 shoulders,
Yeah.
it often means a stock is topping out, reaching the end of its upward run.
Okay.
It suggests that selling pressure is building and the price could be headed for a decline.
Okay, that's important to remember.
Yes.
So as we're analyzing these charts, we're looking for those tight, well-defined patterns like cups with handles, saucers, double bottoms, and those powerful high-tight flags.
Right.
And we're keeping an eye out for that warning sign, the head and shoulders pattern. Is there anything else we should be paying attention to as we put our chart detective skills to work?
Yes. There are a couple more concepts that O'Neill emphasizes that can be really helpful.
Okay.
He talks a lot about relative price strength,
Mm.
but it's not just about buying stocks with the highest overall relative strength.
Mm.
It's about finding stocks that are outperforming the market as they break out of those bases.
So it's not just about how strong a stock has been in the past. It's about how it's performing relative to the market at the moment of truth,
Yes.
that breakout moment.
You got it. And then there's this concept of overhead supply, which can be a bit tricky to grasp at first.
Okay.
Think of it like a ceiling that the stock price is trying to break through.
Okay. I'm visualizing a ceiling. How does this relate to the stock's price movement?
Overhead supply represents price resistance created by a stock's previous downtrend. It's essentially a zone where there are a lot of investors who bought the stock at higher prices and are now waiting for a chance to get out even, or maybe just cut their losses.
So it's like a shadow hanging over the stock,
Mhm.
a reminder of past losses that could make it harder for the price to move higher.
That's a great way to put it. And O'Neill points out that stocks breaking into new high ground for the first time have no overhead supply.
Oh.
It's like they have a clear path ahead of them because there's no one stuck at those higher prices waiting to sell.
That's a really powerful insight. It makes a lot of sense that stocks hitting new highs would have potential advantage.
Exactly. Now, before we wrap up our chart detective training, there's one more piece of wisdom from O'Neill that I think is really important to share.
I'm all ears.
He encourages investors to pay particular attention to newer stocks, companies that have been publicly traded for less than 10 years.
It's interesting. Why is that? What's special about those younger companies?
Well, younger companies often have the most explosive growth potential. They're still in their early stages of development, and if they have a winning product or service, their growth can be incredibly rapid. And O'Neill notes that growth stocks typically peak in performance between years 5 and 10 of operation.
Well.
So while it's important to look at companies of all ages, those younger companies can sometimes offer the most exciting opportunities.
Makes sense. It's like investing in a tree when it's still a sapling. You have the potential to see the most dramatic growth during those early years.
That's a great analogy.
Yeah.
So as you start putting these chart patterns into practice, remember to keep those younger companies in mind.
Okay.
They can add a dynamic element to your portfolio.
Wow, we've really covered a lot of ground today. It's amazing how much we can learn from these stock charts when we know what to look for.
Yeah, it's like unlocking a secret code. These patterns can reveal so much about the underlying forces driving a stock's price.
So to recap, what are the key takeaways here? What do we really need to remember as we start putting these chart detective skills to work?
The first thing to remember is that charts are incredibly powerful tools, but they're not foolproof. They're most effective when combined with a solid understanding of a company's fundamentals. Those earnings, sales, and return on equity figures we talked about earlier.
Right.
Strong chart patterns are even more compelling when the company itself is financially sound.
Right. It's like having all the pieces of the puzzle fit together.
Exactly. And speaking of fitting pieces together, remember that patience is your best friend in the market. Don't jump the gun just because you see a hint of a pattern forming. Wait for those confirmed breakouts with high volume. That surge in volume is like a confirmation signal telling us that big investors are getting on board.
And be extra cautious during those bear markets. Right.
Absolutely. Bear markets can be tricky. It's tempting to try to snatch up bargains when prices are falling. But remember that many of those breakouts during downturns turn out to be false starts.
So it's better to build up cash, analyze past decisions, and wait for calmer seas before setting sail again.
That's a great way to put it. Now, I know this has been a lot of information, and it might seem overwhelming at first. The best way to learn these patterns is to start practicing.
I have an idea. Here's a challenge for our listeners. Are you up for it?
Bring it on.
I challenge you to pick a stock that you're interested in, maybe one you already own or one you've been thinking about adding to your watch list. Go look up its chart and see if you can spot any of the patterns we've talked about today.
I love it. Put on your detective hats, everyone. Look for those cups handles, tight areas, breakouts, and those warning signs, too.
Exactly. You might even spot those high, tight flags, those rare but powerful indicators of strong upward momentum.
And as you're practicing your chart analysis, remember to look beyond just the patterns. Consider those fundamental factors, the company's earnings, sales, and return on equity. And don't forget to pay attention to volume. It tells a story all its own.
And don't be afraid to dig into those newer companies, those that have been publicly traded for less than 10 years. They often have the most exciting growth potential.
That's right. Remember, learning to read charts is a journey, not a destination. The more you practice, the more comfortable you'll become with these patterns. And the more you understand about the forces driving the market, the better equipped you'll be to make informed investment decisions.
So to all our listeners out there, happy charting. May your cups be deep, your handles be strong, and your breakouts be spectacular.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.